Good morning. It's Thursday, the 30th of January, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming as always from Mumbai, India's financial capital. The take: when was India's Sputnik moment? On the 4th of October 1957, the Soviet Union launched the Earth's first artificial satellite, Sputnik 1. Sputnik's launch is and was rightly regarded as the shock that propelled the United States to rush its own space program, though the first satellite launched by NASA a few months later exploded on ground. A few months after that, the first successful launch by the United States followed, by which time the Soviet Union had launched two more satellites, including one that carried a dog into space. The term Sputnik moment refers to a technological wake-up call or shock that has in the past spurred nations like the United States again to fight back with resources and determination, as America did eventually and put a man on the moon in 1969. The Sputnik moment is also being used to describe the launch of DeepSeek, the Chinese artificial intelligence software that has apparently been developed at a fraction of the cost and resources of America's OpenAI and ChatGPT. DeepSeek R1 is AI's Sputnik moment, tweeted venture capitalist Mark Andreessen in a post on Twitter on Sunday. Questions are now being raised on whether India should also be in this race and how. There is, of course, some debate on whether India should be in this race, though the debate was predicated on the over $500 million accumulated investment attributed to OpenAI and not the $6 million that DeepSeek appears to have spent. Infosys chairman and co-founder Nandan Nilekani last month urged Indian AI companies to shift focus from developing large language models or LLMs to crafting practical AI applications. He had said that India's AI trajectory should be less about competing in LLM development and more about building an infrastructure to gather and utilize data, driving meaningful innovation across various sectors. And he also said that the big players should handle that, and India should instead prioritize synthetic data generation, small language models, and training tailored for real-world challenges in India. But at $6 million, this is not so much of a big player game, but a smart player game, which brings us back to the Sputnik moment. First, India's Sputnik moment actually came after Russia's Sputnik, almost at the same time it hit the Americans. The credit goes to Dr. Vikram Sarabhai, seen as the father of India's space program, who convinced the government of the day of the importance of a space program for a developing country like India, which was also a poor one. Sarabhai hailed from a family of industrialists who supported many of his efforts, including setting up the Physical Research Laboratory in Ahmedabad in 1947. The Indian National Committee for Space Research was set up in 1962, of which he became the chairman, and the INCOSPAR later became the Indian Space Research Organization, or ISRO as we know of today. The first satellite, by the way, went up in November 1963. So is this a Sputnik moment for us, like some, though not all, in the United States are seeing it right now? Well, in a different way. DeepSeek demonstrates the power of frugal engineering, going by the information that we have now, something that India has been known for a while. ISRO is perhaps the oldest and best-known example of frugal engineering. Remember the stories of India launching satellites at a cheaper cost than Hollywood films made on space exploration, like the film Gravity? Well, those stories are true. ISRO has demonstrated the coming together of the country's best talent and setting and aligning with a national goal, which further aligned with a global race of sorts. ISRO, by the way, has just achieved its 100th rocket mission. So it is frugal engineering coupled with the best technical talent in the country of the time. So should the government jump into this challenge today? The problem is that government's involvement works in very few areas of technology innovation even today. Innovation in cutting-edge technology is best left to the private sector to do and to determine whether to do, weighing the cost and benefits like it happened in China, and is something that Nandan Nilekani is also alluding to. China's own Sputnik moment, just to remind you, as columnist Thomas Friedman of the New York Times has pointed out, happened in Donald Trump's first term when the flow of technology and semiconductor chips from America started slowing down. As Jim McGregor, author and business consultant who's lived in China for 30 years, told him, he woke them up to the fact that they needed an all-hands-on-deck effort to take their indigenous, scientific, innovative, and advanced manufacturing skills to a new level. India's Sputnik moment lies not so much in cutting-edge technology like AI systems, because we can benefit from cheaper systems wherever they are. By the way, even Alibaba has announced one, but in traditional manufacturing, including areas like automotive. India has been steadily losing share to a host of countries in apparel exports, for example. Bangladesh's share of apparel exports to the United States is 9.3% versus India at 6%. If you think Bangladesh is an exception, remember Indonesia is just behind us at 5.4%, and Cambodia, whose share is rising, is at 4.8%. All three countries are much, much smaller than India. Of course, all of this can sound utterly boring and bereft of glamour. Imagine equating a weakness in garment manufacturing to a Sputnik moment, which is, of course, all about space. But unless Indian industry becomes more competitive and faster, and we find bottom-up solutions to become world leaders in some, if not many, areas of manufacture, Donald Trump's tariff threats will be the least of our problems. And that brings us to the top stories and themes. The stock markets gain again as FII selling slows down and all eyes are now on the Federal Reserve. The rupee closes flat and holds steady. The ONGC's journey from being an oil exploration company to an energy major. Moody's makes the case for a policy revamp in India. Counting down with direct tax expectations to the union budget. And Air India to resume Tel Aviv flights in March.
This is a Core Report with Govindraj Ethiraj.
The Indian market's focus appears to have shifted to what the Federal Reserve might do in the United States on interest rates, as in will it cut further or leave as is, and what clues it provides on the likely direction ahead Wednesday. At least for now, the spotlight is not on domestic cues like growth or the lack of it, earnings, and a falling rupee, all of which are obviously not positive. On the other hand, the markets quite likely look attractive to longer-term investors, particularly in large caps, than they did, or rather more attractive than they did until recently. Just to put that in context, the Nifty and Sensex are down about 11.5% each from record high levels hit on September 27th, and also are on course for their longest monthly losing streak in 23 years, according to Reuters. Meanwhile, on Wednesday, IT stocks picked up along with technology stocks globally as traders digested the impact of DeepSeek, the low-cost Chinese AI model. And among other shifts in the domestic markets, the small caps and mid caps gained almost 3.5% and 2.5%, snapping a 3-session losing run, according to Reuters. The BSE Sensex and NSE Nifty 50 continued their rise for the second consecutive session. The Sensex was up 631 points to close at 76,532. The NSE Nifty 50 was up 205 points to close at 23,163. Among some new stocks and old names, ITC Hotels listed on the bourses following its demerger from ITC's other businesses. The broad markets, like we said, did better than the benchmarks, and the Nifty Small Cap 100 index this time was up about 3.5%, and the Nifty Mid Cap 100 was up about 2.5%. Earnings season is in full flow and several larger companies have now released their results. We will come back with more composite looks in a few days, though the first cut of about 400 listed companies by CRISIL had already projected a slowing earnings run. Bajaj Auto stock rose about 2.5%. TVS Motor jumped about 5.5% after they reported higher quarterly profits and also forecast healthy demand and export growth. Maruti Suzuki was down slightly after its quarterly profit fell short of market estimates due to bigger discounts. Remember that most auto majors, I'm talking about passenger vehicles, gave out pretty substantial discounts in the month of December, hoping to, of course, bring back customers and also reduce their inventory. Meanwhile, one of the operators of McDonald's in India, Westlife Food World, reported a 59% drop in third quarter profits on Wednesday, which has been attributed to consumers cutting back on discretionary spending. It would, of course, be instructive to see whether other companies report similar results. Elsewhere, the rupee closed nearly flat on Wednesday after facing some pressure earlier in the session as traders once again stood by for the US Federal Reserve's monetary policy decision, according to Reuters, adding that the rupee closed at 86 rupees 54 paise against the dollar, almost the same as its previous close of 86 rupees 52 paise. Oil prices are weak. Oil prices are still weak, falling on Wednesday thanks to a rise in US crude stockpiles, according to Reuters, with Brent crude futures now down to about $77.90, basically under $78. The head of commodity strategy at a bank told Reuters that crude prices are now dancing to the rhythm of Trump's tariff orchestra, with Canada tariffs going into effect on Saturday. That's the 1st of February, potentially lifting US prices then. Canada supplies 3.9 million barrels per day of oil to the United States, or rather supplied in 2023, roughly half of overall imports for that year, while Mexico supplied about 733,000 or 0.7 million barrels per day. All of this is data from the Energy Information Administration, or EIA. Where is ONGC headed? On the subject of oil, I caught up with Oil and Natural Gas Corporation, or ONGC Chairman Arun Kumar Singh ahead of the India Energy Week to be held on February 11th in New Delhi in a close to 40-minute exclusive interview that touched on several aspects of ONGC's portfolio of energy activities and also how young aspiring engineers should or could view ONGC. I asked him to describe what was ONGC's strategic views, the trajectory and direction as going from a traditional oil exploration company to an energy company, and what was changing and what lay ahead.
So gradually, what is happening globally, if you see, oil and gas companies are trying to become energy company. That happened in Europe in a big way because if you see, they entered through gas, then they went into power distribution, then power generation. Because one of the things is also true for our country is that our electricity need will be far faster growing than the petroleum need. So if that be the case and the wherewithal of two, three things are a strategic advantage to ONGC in terms of renewable. One is that it has financial muscle to invest. Second is round the clock RTC power can be a combination of gas as well as solar because other options are working but it is at much slower pace. And third thing is that country needs more power. And fourth thing is that ONGC has tremendous project execution capacity. It has been spending 30,000-40,000 crore for donkey years. So unless the organization has the inbound capacity, it couldn't have done it. And fourth, very few people know, ONGC owns OTPC. That is a power company, ONGC Tripura Power Corporation, where we produce around 800 megawatt of power from our gas and sell it to local Northeast and also to Bangladesh. So the capability of ONGC inherently in some pocket of ONGC is existing for power generation, even for transmission. It has a small transmission company which runs power transmission. Of course, that is a JV with Power Grid, which is Northeast. So ONGC is present everywhere in energy value chain today. Only the size is different in different buckets. So this capability and that, there is strategic question, of course, that others may differ with this. Earlier, the natural hedging for an oil and gas company was to be in all three sectors: E&P, midstream, and downstream. And naturally, if upstream doesn't do well, downstream will do well. If downstream doesn't, and that is the reason for all these years, for centuries, only international oil companies survived because they had full integrated value chain. In part, if you exist, you may not survive for long because one bad time comes and you are wiped out. So this is something that was E&P, that same thing. Now, in my personal opinion, I'm not saying it is, that everybody should follow this. Same thing will hold true for oil and gas company, that sooner or later they have to get into the other forms of energy. Because otherwise, if you are only in E&P, today oil and gas takes a back seat, then of course you have maybe having a short shelf life. But that will not happen in India because Indian context में 30-40 years oil and gas is going to kick. But if you take a long-term view, oil and gas company has to ultimately become energy company. Energy comes from whatever source, even nuclear power, even CBG, even the ethanol, even the oil and gas, even so entire energy basket, whatever primary energy basket today exists in the world, any source. You should be in all the place to survive for centuries. If you want to survive for a few decades, then it's fine, you remain segregated.
And how does, let's say, management time get divided between searching for new sources of energy or exploring new options like the ones you said? You talked about coal-based methane, for example, and there are many others as well, versus, let's say, the traditional.
So my personal time, I've taken account 92% in last 2 years has gone to conventional E&P. Because OVL is run independently by MD OVL. So there is a separate board. Only I sit in chairman of board meeting, non-executive chairman. I'm non-executive chairman of MRPL. I'm non-executive chairman of OPAL. So these don't take much of my time. And fortunately, management is very competent in all these subsidiaries. So they run on their own. But overall situation that I'm aware of. But my personal time goes in still E&P, and in that particularly, at least 40% of the time goes to if something we can do great in exploration and also in enhancing production from our existing fields. Like a lot of time has gone into, stitching this tie-ups and all that. And it is a win-win conditionality from both sides. So time-wise, we are fair, but one of the things that we still continue to focus on E&P. Renewable also doesn't take much of my time because we have created a company called ONGC Green Limited. It is run by that management. And only they come to ONGC for money because ONGC has the resources. So that role I perform in the board meeting, nothing more than this.
You can catch that whole interview on YouTube and Spotify as well. This segment was supported by the India Energy Week 2025, scheduled from February 11th to 14th in New Delhi, and you can register for the same using the link in the show notes. Moody's makes the case for a revamp. India needs to change its fiscal and monetary policy to achieve a 6.4% GDP growth in 25 amidst a weak rupee, declining foreign investment and volatile inflation, Moody's Analytics said on Wednesday in a report quoted by Business Standard. Moody said while India had one of the fastest growing economies in Asia in 24, GDP growth has waned over the first 3 quarters, and it now expects the 25-26 union budget, that's day after, to support domestic demand, particularly investment, while aiming for a fiscal deficit of less than 4.5% of GDP for the next fiscal. Moody Analytics said that India is facing a bumpy road in 2025. A weakening rupee, declining foreign investment, and a volatile inflation are the areas of greatest economic risk, and changes in fiscal and monetary policy, likely in the first half of the year, is needed if India is to achieve 6.4% growth. It also said that the slowdown versus 2023 has set a cautious tone for 2025, and with interest rates staying higher for long, domestic demand could moderate. Moody's is, however, seeing limited impact of potential Trump tariffs because while it could make the export environment challenging, it won't be too influential given India's relatively closed economy. Moody's also said that the rupee has weakened significantly since the start of the US Federal Reserve's easing cycle in September, and Trump's win has only put more pressure on the rupee as investors have sold Indian assets, jumping on a greenback rally. That's the dollar. Moody's also pointed out that the rupee hasn't weakened as much as some other developing economies' currencies, but they do expect it to keep depreciating over the long term as a growing middle class increases the country's reliance on imports. Aluminium and the Russian angle. Aluminium prices rose on Wednesday on reports that the European Union is firming up a plan to gradually ban imports of the metal from Russia. This plan is part of a broad sanctions package ahead of the 3rd anniversary, and that's the significant part here, of the Kremlin's invasion of Ukraine, according to Bloomberg. The package, which has been circulated amongst member states this week, also proposes sanctions which would cut more banks off from the SWIFT banking system and actions targeting more than 70 dark fleet vessels involved in shipping Russian oil, according to Bloomberg. The plan would allow European buyers to import about 275,000 tons of Russian aluminum under a quota system for a 1-year period before a full ban comes into effect. There have been calls for the EU to ban Russian aluminum ever since the invasion of Ukraine. Air India to resume flights to Tel Aviv. And in some sign of normalcy returning to both geopolitics and aviation and travel, at least in one part of the world, in this case the Middle East, Air India has announced it is resuming its non-stop services between Delhi and Tel Aviv. This is 5 times a week on a Boeing 787-8 Dreamliner aircraft. The services will start, or rather resume, from the 2nd of March, the airline said yesterday. A direct tax wish list. The union budget is the day after tomorrow, and there is much expectation around direct taxes, including how they're administered. It's quite likely that a new direct tax code will not make its debut as expected because work, it appears, is still on, with some 22 subcommittees working furiously and also wading through some 6,500 suggestions. I reached out to Riaz Thingna, chartered accountant and partner at Grant Thornton Bharat LLP, and I asked him to give us an overview on how tax collections have done in the last year and what he foresaw from the union budget this year and his wish list for the same.
Firstly, yes, the trends are pretty robust. So the overall collection of direct tax, which was budgeted at about 22 lakh crores, is likely to exceed by at least 70 to 80,000 crores for direct tax alone. At the same time, even GST collections are expected to rise by 9 to 10% over the previous year. So overall, the tax to GDP ratio, which is about 11.85% this year, and direct tax at 6.81% are both significantly higher than the previous year. So I think overall the robust collection. And with overall increase in GDP, there may be a little bit of a fall as far as tax buoyancy is concerned, but overall a very, very good collection. One additional thing I would like to talk about is that within direct tax, there has been a good nuance that the non-corporate tax has been rising as compared to corporate tax, and the difference is widening. So there is greater emphasis on non-corporate tax.
So when you say non-corporate, you mean personal tax?
Personal income tax and partnership firms, etc. That is rising. And now, when that is rising, there is scope for the finance minister to try and see how to boost consumption by giving some reliefs on that side.
If you were to now look at the budget specifically, let me ask you two kinds of things. One is administrative areas that you feel the budget needs to address, and then we could come to any specific clause or section within the tax that you feel we need to look at closely.
Yeah, that's an interesting question because on the administrative side, one thing clearly which is top of mind is how do you clear the backlog of litigation? The controversy management is a nightmare. Now, that is where we need some steps taken. Number one, just increase the capacity at the CIT appeal level, at the tribunal levels to bring down the burden and the backlog. Second will be codify some of these time limits into the act itself so that they are strictly followed. The 6 months and 1 year limits should be strictly followed, which is another thing. Thirdly, and this is a long-standing demand, we try and bring in some tax mediation, and that is really going to help. And I think that would be one of the best practices to follow also. The tax mediation would definitely help in reducing the burden. So I think these are some of the areas where we need to take steps and reduce the level of litigation that is going on.
And when you say tax mediation, can you expand on that? I mean, what do we have today as of now and what we need to do?
So as of now, there is only an appellate process. So you have a disallowance, you go into appeal, whether it is a commissioner appeal or thereafter the income tax tribunals or thereafter the courts. The other alternative would be that wherever there is interpretational issue and where there are arguments, you have committee, a panel, which can sit across and discuss what should be the ideal way forward and what would be a fair way forward. So you don't even get to the controversy state. That would be the mediation process that I'm looking at. And it could work in a number of situations where there are genuine interpretational issues and not any evasion of tax.
And this is something that obviously many countries already have in some version or the other.
Absolutely. US is being the first example. So we do have tax mediation. I think that's something that we need to focus on.
Right. And are there any specific areas within the tax code? Now, of course, the tax code itself may not necessarily come in the way that was anticipated because there's still work going on. But anything within the tax code or the tax act?
Yeah. So, the tax code process has started. Various subcommittees have been set up, or I think about 22 subcommittees, 6,500 inputs have come in from various stakeholders, etc. So it will take about a year to finish. Now, the focus of this tax code, it's a comprehensive review of the existing tax code. So the focus there, it's not a new code. So when you say that, the focus will be on simplification and rationalization. So while a lot of work has to be done, we could expect that during this budget, you could have some of those elements which are identified introduced towards that rationalization and simplification process.
What's an example that for you is, let's say, typifies the problem with the current code or the current act?
There are certain settled interpretational issues which we know that we can put an end to the litigation because there have been decisions of the Supreme Court, so that can be codified. There can be a reduction of the cross-referencing of sections because when you have all these cross-referencing of sections, you definitely have more doubts create. But we can have a certain simplification of rates, TDS being the prime example. At TDS, we today have about 40 odd sections on TDS alone. Now, PDS was initiated with a dual purpose. One was to plug tax leakages, and the other was to create a documentation trail. Now, today, the documentation trail part is not important with all the digital tools available with the government. So, it is only about plugging tax leakages. For that alone, 40 sections, of which about 3 or 4 sections contribute to over 85% of the collections. Why do we need that many sections with varying rates from 0.1% to 40%? And, these rates just create a lot of confusion, create a lot of non-compliances. So I think towards that, we need something that reduces the number of those sections, number one, and at least brings in 3 or 4 different rates and not these multiplicity of rates. That is an area which can be looked at this point of time. Then, of course, tax rates for individuals, bringing it on par with corporates, etc. Those are the kind of things that one can expect.
Right. Riaz, thank you so much for joining me.
Thank you. It's a pleasure.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.